I can also introduce our other members of the panel today. The discussion is entitled Consolidation Strategies, and it will be chaired by Lynda Woods. If I can ask the panel members to please make their way to join Glenn at the table at the front. In addition to Glenn, our second panel member is Adam Twemlow. Adam is a partner at KPMG and has 15 years audit and advisory experience. He also has extensive experience in coordinating the audits of listed and unlisted public companies and large private companies. Adam has significant experience working on the audits of mining and exploration companies and with businesses in the startup phase. Adam has also gained a wide range of international exposure and spent several years in London with the Royal Bank of Scotland in the role of Group Treasury Financial Controller. Adam also spent time in the US with KPMG and was involved with US oil and gas companies. Please welcome Adam to the panel. Our third panel member is Phillip Nyssen. Phillip is founder and director of Property Joint Ventures, which was established to develop solid investment returns and property through careful project development and management strategies. Phillip's company targets a syndicate of mature investors to attract banks with their independent equity, a quality project and quality development partners, reduced risk agreements and repeated delivery. Phillip is passionate about helping business leaders identify meaningful improvements and supporting them deliver business benefits. Please welcome Phillip to the panel. Our chair is Lynda Woods, who's Private Clients Investment Advisor at RBS Morgans. Please welcome Lynda.
Wonderful, thank you. And it's now Morgans CIMB, just so that the panel's aware, CIMB is Commercial International Merchant Bankers. Not to say that there's anything wrong with RBS, it's just that they don't exist anymore. So are we right with sound? Good? Okay, oh, no one waved, so that means no one can hear me. Great. And we've got some students down the back. Welcome, and I hope you're enjoying today's session. Let's just get straight into this, but I'm going to give you just a couple of stats. Something that Glenn touched on is how many businesses are looking for exit strategies, consolidation, mergers, acquisitions, things like that. And why is that so prevalent at the moment? Well, a couple of things. We've gone through the GFC, we've come out the other side. So valuations hopefully are a little bit more positive. But apart from someone turning their phone on to silent, thank you. Just a stat, baby boomers turned 65 in 2011, and every week for the next 17 years, there'll be another 4,000 reaching that age. Now, why is that important? The average age of a small business owner at the moment is 58. Okay? You can see what's going to happen here? It's predicted that over 50,000 small businesses per annum right now, for the next 17 years, we'll be looking for some sort of exit or consolidation strategy. 50,000 a year. So, yeah, consolidation could be one way. It is definitely back in vogue. I spoke to our corporate team at Morgans CIMB last night and said, just give me one word, what's happening in the consolidation M&A space? And the head guy in corporate gave me the one word, and it was astronomical. He also commented later, there's been a couple of demergers, so we might touch on that a little bit later on. But Glenn, being the advisor, stockbroker person that I am, Glenn, you did touch on, so many elements of going into consolidation. If I can start with you and we'll work through the panel. What's it like to actually discuss the potential sale with the owner of the business? When you're first approaching them, what are some of the issues that does arise?
Well, what we found is they're just happy that someone's talking to them about buying their business, because a lot of them in the vet industry particularly, which is the same other industries, is their exit strategy is maybe they find one or two younger people in their business that can vendor the business to them over a 10-year period. So when finally someone comes talked about buying their business for cash, they're just happy, and they usually don't ask a lot of questions to verify how qualified you are, because they're just happy someone's talking about buying their business.
Adam, if I can go to you and just talk on, if someone's going to buy your business, we need to have a valuation. I mean, what are some of the issues? How many people are in this position? They don't even know what their business is worth. What are some of the issues around that?
Sure. So look, from a risk perspective, it's around quality of earnings. So obviously, the better the quality of the earnings, the greater the multiple you'll get. So certainly, from a vendor's perspective, it's always in their interest to have a solid track record, which can be perhaps audited or proven to add the value and the corporate governance around the business. And I guess the better the governance, the better the quality of the earnings, typically the better the outcome for the vendor.
Yeah, Phillip, you were nodding then. What experiences have you seen of that of late?
Well, when it comes to the governance, in our model, what we'll do is attract the kind of quality of investors to align interests. So one of the key things is that not only in the internal operations, but if you can attract the kind of investors that not only bring the cash, but also bring that additional experience. So when you're bringing them on board, I found it makes a dramatic difference to the kind of results, because ultimately we take a slightly different approach beyond purely listings. We also look at alternate funding strategies around joint venturing. And in that case, it gives, a bit of an X factor and repeatability of that business model that you may not find elsewhere.
Okay, so we've already identified a couple of different ways of, obviously, Glenn, were you intentionally thinking of going to listing when you were consolidating? Okay, and Phillip, in your case, it probably wasn't actually going down that path. Are there specific industries and sectors that you're targeting that don't go to IPO?
Well, we're focused on 4 areas. It's property, agriculture, energy and health. And what we're also doing is we're focusing on boutique niches in each of those. The reason is because we believe increasingly as investment volatility, let's say, increases, we want niches that we understand the profit margin in, that we can also then leverage the expertise of our investor community across those 4 areas and actually come up with unique blends. So we might, bring property and health together, and with our investor group, use their insider knowledge as doctors into investing in, medical-related properties. So we're looking for the blend. Similarly, so we are taking a different strategy that way, and hopefully that's, you'll see more of that.
Mm-hmm. Adam, immediately when I'm thinking of what Phillip's just said, and I think that's great, it almost sounds like a Wesfarmers starting up. And as if they're never going to list, right? I love hearing these stories. But Adam, what are some of the dangers of that? When we're talking about those industries, do they often have fine margins? What are some of the dangers with that and the valuations?
Yeah, sure. Look, I guess I sit on the side of the fence really around the corporate advisor. So I advise typically the vendor or the purchaser coming in. So it's either a vendor due diligence or a purchaser's due diligence. The areas that we typically look at is around maintainable earnings. So just coming back to that quality question around what is in it, is there any one-off non-recurring type items? Obviously, when you're talking around skinny margins, it needs to be a good fit. So the cultural question comes into it as well. Comes back to the values of the business. Is it a good cultural fit? Sometimes you can have 2 tremendous businesses that both have fantastic margins, great EBIT, but just may not be a fit for a number of reasons. And it could be as simple as the values of the business. So it's always important to look at that and understand the fabric behind the business and make sure that what you're putting together can work.
Glenn, you did mention with one of the takeovers of the vets that you actually closed one of the outlets down. Was that because the margins didn't work? Was that a cultural misfit? What were the issues around that?
It was a vet clinic that was just struggling, but it was part of the purchase. So sometimes when you're putting a group together, if a guy's got 5, he may have 4 that are good, or 3 that are really good, 1 that are above average, and 1's like a dog, for example. He sells you the whole package. You can't, So, and I guess for what we're doing, because we're going to list, you need to get critical size. So you need, you need a certain number to make that critical size, because you're adding a corporate overhead expense to these businesses that weren't there to start off with. So you need as much size as possible to make that happen.
At what point does size then become the issue? I mean, doing acquisitions for the sake of acquisitions to grow.
What size?
Yeah, at what point does the size become a problem? Like you're just buying for the sake of buying. Yeah.
Sure. I guess what it comes down to, stockbrokers would look at as long as you're increasing your earnings per share every time you do an acquisition. I'm sure per industry there would be some certain particulars about certain size. You know, like for example, childcare. I've heard that once you get to a certain size, any acquisitions you make after that doesn't really benefit the business. But I'm not quite sure. But as long as I guess you're increasing the share value of it each time you make a purchase, and the business is growing.
Yeah, that's an interesting point. Adam, we mentioned at the table earlier about acquisitions and getting the valuations wrong. ABC was an example of getting it wrong. Do you want to just comment on that?
Sure. Look, I guess ABC was quite a unique beast. Really, at the end of the day, when we look at businesses that are planning on acquiring and growing through roll-ups, it really comes down to the price and the multiple that you're paying. So obviously that is such a critical factor around making sure, particularly if you're going to leverage it and gear it. So I think when you come back to the ABC model, they were doing a couple of things in my view. One was around the price that they paid for it, and then gearing that price and obviously leveraging their acquisitions. The second was around the property play as opposed to the actual business play. So were they in the business of childcare or were they in the business of buying real property? And I guess that really comes back to what is your expertise, what's your business model, do you have a clear strategy around what you're doing? We've got a couple of clients at the moment that are going through the roll-up consolidation phases, and one of them's in the supermarket chain, so amalgamating IGA supermarkets, and there's a couple of big players out there. So coming back to one of the points Glenn made is around, yes, sometimes you have to take a package of businesses, and sometimes they're not all winners. Sometimes there's a couple of dogs in there as well. And certainly then it's being able to smartly deal with that and identify it and be able to divest to improve the quality of your earnings and the quality of your group. And I know that that's something that my clients look at regularly is, okay, I need a bundle of 6 here because the vendor obviously won't sell the good ones and leave the bad ones behind. But being able to quickly identify, okay, maybe it is a bad one, but is there value there through amalgamating back office, combining some of the resources such as the overheads that go in? Does it help you improve your purchasing power? So are you getting rebates from suppliers, those sort of things? So I guess at the end of the day, it comes back to the model, making sure that what you're doing makes sense. One of the things Glenn mentioned is around just being earnings positive, but also putting the right multiple on it.
Phillip, if I can get a comment from you, we've talked a lot about the financial side of the consolidation. What about the emotional side, the cultural side, the emotional side? Usually we're going to be dealing with families, small business owners consolidating, and I don't know about you, but I know when my dad ran his business, his way was the best way and no one could tell him how to do it better. What are some of those issues around that?
I like to ask the question around who else out there would like to see you succeed, and hopefully you can start by saying your wife as well. That's the family support is critical, but actually beyond that, there's a lot of people who do a startup and beyond their own excitement around their business. When you ask them that question, who else in the business community wants to see their business succeed? They often go quiet because they're not sure. If you can create a business where there's an ecosystem of people that want to see you succeed and you understand why in a sustainable basis, you have a level of foundation for success through that asking that question. And until you can get that answer, I'd keep asking it. So some of the issues I've seen ultimately comes down through to alignment of interests at the emotional, personal level that you're saying, but also for personal education. I know it maybe not be at the forefront of people's idea initially around investing, it's around return. But I find the most sustainable partnerships at a corporate level, or even at a personal level, are where you're actually with people that are learning and growing together. So I look for those elements around success, education, and then ultimately, yes, around those partnerships that can grow through your success as well. And line those things up, and then I think you're on the way.
That's great. Really good questions that you posed to them. Glenn, in the very, very early days of putting Green Cross together, what were some of those sorts of cultural, emotional issues that you came across, trying to sell your story of to consolidate is the right reason? Other than the money.
I guess the people that we talk to are the ones that were interested in selling their business. There was some concern, I guess, so when we put it together, we hadn't finalized who the management was. So there was always that concern, you know, who's going to run this, but we were very front up. It's not going to be us. We'll have someone from within the industry that will be running this project. So most of the vendors, well, all the ones that we dealt with were all the ones that wanted to sell their business. With saying that, again, because we weren't going to be running the business when Green Cross came in, as far as Glenn Richards, John Audlin, you know, when we had, I think, 30 different clinics, you're going to, you know, just the numbers purely by themselves, you're going to have personality conflicts that happen. They had one clinic that was in, I think, Capalaba, husband and wife team, and it just never worked. And so eventually they had to leave earlier, but it was just a personality clash that you just couldn't avoid. So.
How do you manage that exit strategy when you've gone down that path, then you've got to move them out?
Sorry?
How do you manage the exit strategy of that couple then out? Or was that just part of the screening process that they didn't get in?
I can't hear, sorry.
Oh, sorry. How did you manage getting rid of the couple that weren't going to fit in?
They agreed that it's time for both parties to move on. They paid them out earlier. Because I guess whenever we did an acquisition, there's an earn-out period to make sure that vendors are going to be through the process with you. So out of the 31 settlements that happened, there's really only a couple that weren't smooth. Surprisingly enough, a lot of them are still there, which I'm very surprised. But I guess it does show that what does a vet do when he sells his business? He remains being a vet. So as long as the environment there is a happy place for him, he'll still work for you as a vet.
Fantastic, thanks Glenn, great response. Adam, from your point of view too, as the advisor, you're sitting on the other side, what sort of advice are you giving back to the potential clients that are going to consolidate?
Sure, look, typically come back to one of Glenn's points earlier, they want to sell, they want to get out. They're looking for options to realise their business and turn it into cash and or script. And so typically it comes, from my perspective, a very important question is the consideration for the business going to be cash or script? And then doing the due diligence back on the acquiring party. So if I have a very successful business that I've run for 20 years and I have a potential opportunity to sell into a bigger amalgamated group, my question's going to be, do I want their script? And if they're not paying cash, how do I get comfort that that script is quality and I can realise it in the market at a price that I'm happy with in a reasonable amount of time?
Yeah, Glenn, you have something to say?
Yes, please. So we were on the other end of this. Well, we put Green Cross together. It made for us, it made sense. You guys should be taking some script. None of them would take script, absolutely. And even to the last probably 2 weeks before we listed, John Alwyn, Glenn Richards, Stephen Coles, the three vets that were directors, none of them were taking script. And it wasn't until literally 2-3 weeks before it listed that the penny dropped. You really should be taking some script. And in the vet industry, because still involved with the vet industry, it really skews the language. It really pisses a lot of vets off that John Odelman's worth 40 million, Glenn Richards is worth 50, Stephen Cole's and they all know that they didn't have dynamic businesses. They had a business that's a little bit bigger than theirs, and now they're wealthy types. So we always tried to explain you should take some, but we just couldn't get it across the line because there's too many unknowns, what's going to happen, blah, blah, blah. But now everyone wished they would have took some script. So
from my point of view, we'll come to Phillip in a second, but we actually like it if people are taking script. We actually view it very positively from our point of view. And then the next question I always ask is, how long's the escrow period? That's probably another breakfast another time, because that is a huge thing. That's a massive thing from the person sitting on the other side of the phone who's then got to sell the story to other investors. Yeah, it's very important for us. Phillip, your experience?
I just find that behaviour, it's a human behaviour that's consistent, whether you're the CEO of a company or a business owner. Often you focus on what you know best, and that is how to operate that company or lead that business. You may not necessarily have the mindset of an investor, and that's really what you're asking them to do. And to me, I think that's a huge gap as a group of investors and entrepreneurs. We need to help other people cross to keep that generation of wealth from purely being consolidated to corporates, but for new entrepreneurs to bridge that gap from leading to investing and helping others to see how to do it as well. And I can see you're doing that, and that's why I've loved this roll-up model. But there's a lot more education needed and around that. Yeah.
Yeah, Adam?
Yeah, I might just say a couple of quick words around planning it and getting the structure right is so vitally important. There's a startup company on the Gold Coast at the moment which is in technology and data manipulation, I guess. And they are going forward in leaps and bounds. And the investors in that, two fellows that hold the majority of the stock, have actually planned ahead and moved overseas into tax-friendly jurisdictions, planning for the ultimate divestment of this company. So it's really around managing the tax side, and that is extremely important. And if you are going to take cash and or script, and you do well you do well with your consideration, obviously there's going to be a tax bill attached to it. How do you fund the tax bill, and how do you best plan for that tax bill to minimise it?
Glenn, can I ask you a question? When you're looking at corporate advice, what would you then be looking at, given what Adam's just been saying? How do you look at that from a corporate advice point of view of what you're doing? What do you look for?
Sorry, what do I look for?
Corporate advisors, yeah. What do you look for in corporate advisors to you?
So like an accountant telling me what to do? Yes. I guess what we found, you need to find an accountant and a lawyer that you can go to them and say, I gotta, what do I do here? What we found, majority won't give you answers because it's up to you to find the answers, I guess. But if you can find ones that are willing to give you answers, they're worth, surprisingly, we struggle with that, finding ones that would give us answers that we'd understand, probably. Maybe that's a better way of saying it.
That's a pretty good response.
Sorry?
Options.
Option. Yes.
Yeah,
Yes.
good point. Adam, do you want to jump in on that?
Yeah, look, I think that's absolutely right. It's all around options, and it comes back to the experience and what have you seen work in the past. And if you can talk about some examples around, look, we've done 3 or 4 of these models before, and this is what I've seen that works, this is what hasn't worked, and in my view, I think this is probably the preferred option.
But Adam, is that what's worked specifically because of a past experience may not necessarily then be a negative for the individual sitting in front of you? So you break it down even further, that it's personal advice, not just general advice?
That's right. Every deal's different, and every structure's different. Every consideration structure around how you get remunerated at the end of the day is different as well. And that comes down to the individual, comes down to their needs, what do they want out of the deal, what's important to them. So initially you need to sit down up front and understand what are the objectives. What are the objectives of the transaction, and the objectives between 2 different people, could even be 2 shareholders in the same business, might have different objectives. And when it comes down to structuring your advice, it needs to be around achieving those objectives.
Phillip, have you had any positive or negative experiences in that area, getting advice?
Mostly what I look for, not necessarily, but mostly what I look for is for my advisors, my confidants, to have what I would see the kind of aligned interest that I'm clear that they can succeed themselves through my success. That's, again, I do go back to behavioural type answers a lot, rather than just purely corporate finance type answers. But to me, that's the leading indicator of long-term success that I've ever seen in consulting. So ultimately, yeah, I definitely am challenging. I will ask for options like you were describing before. I'm not happy just with a single answer, but my advisors are there because they will, if they succeed, I'm more confident that I'll succeed. So I haven't been in a position though of asking for structured advice around our companies for listing or anything like that.
Phillip, just out of curiosity, you've earlier mentioned what industries you're working with.
Yep.
Why those industries specifically?
I've created an investment model that I can be proud of for the rest of my life, and my children grow up in. Those 4 areas, property, energy, health and agriculture, are fundamental to healthy communities, both here in Australia or elsewhere. I'm growing a model that I feel is highly scalable and repeatable in other locations. It's also the kind of model that it's a model not just to attract dollars but to attract people. And the kind of people who are interested in those areas and innovate in those areas often have a purpose to help broader communities. And so I'm personally finding a blend where I can attract the dollars, grow as a person, and attract the kind of people I want to keep building with. The interesting thing I've found, just because I've spent a lot of time with PricewaterhouseCoopers, other companies around the world, is that there's this growing demographic of people who want to see change, want to see the world work, and are actually highly educated, mobile, and with deployable capital. If you give those people the opportunity in those kind of areas, they'll play, they'll bring money, and they'll bring a lot of innovation. So essentially, I've chosen those areas because I can access them as a network business. I can access the kind of people I may not have necessarily met in a corporate world, and it's given me a platform really to create a diversified, highly resilient business. And that's why I'm passionate about those areas. They're always in demand.
So the emotional selling of the story really does work for you. It's the emotional journey as well.
It is. Look, one thing I've learned in all those businesses is there's the saying, culture eats strategy for breakfast. So, and it's quite powerful when you unpick all the advice and great structures in the world and all the rest. Ultimately, it still comes down to the people. More often than not, I can walk into a company and within about 5 minutes of talking to the people and seeing the way they play and communicate with each other, I already know the way the business is working. So if you can get the emotional story for the short and long term right, not only will you have a great team in the present, but you'll attract the people in the future. And if you look at any of the great growth stories of whether it's technology companies or whatever, while they might have attracted great cash flow, they had the kind of leader that had just started attracting the people that actually created the company and the vision really from that point on. So I do work from there. That's my personal bent, I'll use the expertise of people like Paul and Adam and Glenn here.
Yeah. Glenn, so if Phil's coming from the heart, you're coming from the hip pocket.
Can you ask me that question? Can you ask me that question too?
Yes, please. Can you please answer the same question? Yeah.
I'd love to. Thank you for asking. I guess for me, what we look at is, can we get the funding for this? Obviously, the funding that we're usually looking at is through brokers or funds, and the last 3 or 4 years, it's all about mining. So if it's not mining, you're going to have the best business in the world. You just did not have an opportunity at all. And now that's stopped. It's changed over to now it's aggregations, like a normal business. So for us, we look at it and say, okay, can we get the funding for this? Is there appetite for this type of project in the next year? Because it is cyclical. Like sometimes the broker, the investment community is happy with agriculture, or it's not, or it's happy with mining, that's not, or it's happy with aggregation. So effectively, that's what gauges us. In this market, can we get the funding for this? If the answer is yes, then we'll take that. We'll invest our time and our money there, because if we can't get something across the line, as everyone knows, costs a lot of money. We don't get any return on that money at all. So that's our main tick that we look for is there appetite for this type of project right now?
What about from the emotional side, though, when you're dealing with these people? Because you're having to sell the story to them of what you're going to be doing for them.
I guess, so again, fortunately there's so many people that want to sell their business. So we deal with people that want to sell their business, and then we, if we go into business and we have to sell them ourselves, we find it doesn't work. Like they're too attached to their business. They want to know 1,000,001 details, which when we're putting a group together, as we're doing, a few things now, A lot of these answers aren't answered to the very end. You know, when we put in a group together, like when we put Green Cross, we didn't have the management to the very end, but we knew it's basically a principle. You build it, they will come type of scenario. You build the project together, and then at the end, you then start finalizing your management and all that kind of stuff. To do that at the beginning, it doesn't happen. Like, we made that mistake with Green Cross at the beginning. We went and approached Green Cross right at the very first because they seemed to have the most clinics. That was the worst thing that we could have done because we were too academic, and we wasted 2 years dealing with them. They said they would sell, then they weren't going to sell, and then they're not going to sell. The point they said they're going to sell, we got the stockbrokers all excited about it, then they weren't going to do it. And it wasn't until that we had enough clinics that without them that we're going to do it, then they agreed we'll get involved. So as far as us, people that really want all the 100% details with what we're doing, we can't give that at the beginning. So the ones that want to sell their business, they're the ones that we have success with.
So Adam, let's play a hypothetical. Let's say you're talking to a client and they're in a business that fits in both with Green Cross and with Phil, and they come to you. They're your two options. How are you going to manage that?
We'll pay more.
Unfortunately, that's probably the right answer. At the end of the day, yeah, what's the price and what form does it come in? So is it cash grip, whatever. So at the end of the day, most people are in it for the dollars.
What if I'm emotionally attached? Yeah.
Usually once you get your cash, you're no longer...
Oh, okay. Yeah, good point, Glenn.
We find vendors are all lovey-dovey, all that kind of stuff. But once they got their cash, it's usually 3 or 6 months after that lovey-doveyness is gone.
Sounds like a divorce, yeah.
Look, I guess some of the discussion here is really around exiting for the point of view of realising a business and putting some cash on the table. I look at the business that I'm in the industry I'm in, amalgamations and mergers have happened around getting critical size and scale, and that's to improve profitability, market reach, geographical presence, those types of things. So earlier I made a point around what are the objectives of the particular vendors. Your objective could be to put cash on the table. The other objective might be around to improve the quality of the business, and that comes to scale, geography, all those types of things. So looking at the big four accounting firms, going back to the mid-80s, there was 9, went through a rationalisation process over 20 years where 9 became 4, with the last one being Arthur Andersen that dissolved back in 2002. So I guess the reason why those firms went through that amalgamation process wasn't to put cash on the table for exit strategies for partners, but more around improving the quality of the business. A lot of the discussion today has gone around, okay, well, we're exiting for the point of view of putting cash on the table. A lot of amalgamations and mergers aren't with that objective in mind. And I guess the space that I'm talking about, culture is such an important factor. And that comes back to the emotion that you're talking about, Lynda, is how do you get that cultural piece to work, and is it a good fit? So when Coopers Lybrand and Price Waterhouse joined together, that was a global decision. It's pretty hard to manage emotion and culture on a global scale, and there will always be fallouts, and that happened at the highest sense around them wanting to be a large and the biggest, if not one of the biggest, accounting firms. And you put those two together, you've got massive cultural, emotional issues to deal with. There's going to be rationalisation, exiting of partners, all those sorts of things to refine the business post-merger.
Yeah, and look, we've seen that with AMP and AXA, but then also we've seen demergers, Westfield and WRT. But Phillip, what are some of the issues that Adam was just saying then, when you're putting these things together, but the cultural fits don't work?
Again, one of the results of the cultural fit's not working is far too often you see substantial value destruction. Often the merger's happening because the CEO wants to see it happen because he's, incentivised for that. Not only, but far too often. So, when bringing it back to the niche space, I just want to reflect the fact that we need different business models out there. Clearly, what I'm talking about, I think, is more of a niche model rather than a roll up onto the stock market model. But the principles still apply that at a corporate level, we need to, I think, in my view, I think there's got to be a great awareness of the role of culture, and fundamentally, it's, in my mind, the critical defining element of the businesses that are going to innovate. Not just at a technological level, at a people level. And if you want to look at those business innovation and sign of success, culture is the key to it. If those that are just going to be purely scale and make money through a technically scalable platform, that's a completely different model. So we need to just be clear about what kind of business we're in and what's the defining element of its success. And if it's innovation, then culture is going to be the key determinant of it. And any business that doesn't take that into account ultimately will be on the receiving end, I think, of value destruction from the merger.
Well, yeah, and just sideways, if not negative.
Yeah.
So behavioural psychology is extremely important.
I find increasingly so. And when you look at the next generation coming through, while they may be using technology to network, I find they're even more social than our generation in many ways. And I'm very optimistic about the future, but I think I was built that way too. So
Yeah, look, I just got a new app on my phone called WeChat, so it's the big thing in Asia. If you don't have it, get it, because you're way behind. That's so last century if you don't have it. Glenn, any comments on that?
I agree with what Phil was saying, as far as if you're looking at mergers of two bigger companies, culture is obviously a critical thing. Where if you're looking at a roll-up of mums and dads types of businesses, usually the culture of a small mum and dad business in a bigger group over a period of time is usually a more positive thing. What we found with, and what I've heard since from vets that didn't sell into Green Cross, that Green Cross has now got the critical size where they got, they're training their nurses, they go to school for training nurses, where other vets are very jealous of that because, so actually that model is actually building up and making the business actually stronger by providing more services, more training for the younger people, which supports the business. So,
Glenn, I was listening to News Radio on the weekend and they were talking about vets in WA, and they have one of the highest suicide levels as a occupation, unfortunately, until Green Cross has just come in and made their big move in WA. And so from a mental health point of view and from a medical point of view, they actually see that as an amazing positive that a company on the stock exchange could potentially be saving lives, because it does give that single business owner some new hope for the future and for their family. Look, we've got just 1 or 2 minutes to take a question from the floor and try and make it a little bit more positive than my last note. Yep, we've got 2 down the back. Do you mind just... Oh, we're going to grab a microphone. Here, Rick.
My name's Paul Niederer. I was involved in the cleanup of an ASX roll-up, and one of the hard lessons learnt from it was that if there's a craftsman or artist aspect of the business, like this was in dental laboratories, that they could start up over the street the next day and all their people would go there. And what was interesting with you, Glenn, said in terms of being managed outside, we could manage them administratively, but that cultural aspect, as soon as they got to the end of their 3 years, some of them had the moral compass that it didn't matter, they were going to set up and that was a hard learning, really, that craftsmen and artists have a following and they can move across the street. And I was just wondering on your feedback in terms of that sort of environment.
So I actually looked at Dental Labs business. We actually had a look at it. I guess the probably one of the issues of for that business model is there's very low barrier of entry. So a lot of them are under people's houses. So, it doesn't cost anything for them to set up and go somewhere else. But with saying with that, I think there's the challenges there. It's a big industry. You make a lot more margins than you do with Green Cross. So the challenge is how do you get the best out of your people to grow your business? So.
Hi, Brian Vardis. A question for Glenn. Glenn, you mentioned about the market appetite. How do you go about validating the market appetite for a particular project that you have in mind?
Yeah, over the period of time, I've dealt with enough stockbrokers that I go have a chat with. Usually they're negative to start off with, but if they don't shoot you down in flames, then you know, okay, there's potentially a project there. A lot of it comes down to the size. So if you got decent numbers, again, it comes down to your story. If it's a good growth story, and again, it all depends on the market. When we originally did Green Cross, we were dealing with RBS in Brisbane, Morgans, and they were going, yep, let's do this. And then during that process, they did run the property people, and that just fell apart when we were in the process of doing ours. And then one of the directors there came back and says, you need to change your whole IM, take aggregation out of it. It's got to be all focused on organic growth. So effectively, talk to a few brokers that you know that I guess you understand what if they're saying yes, then you got an idea that you can make it happen.
Yeah, I would like to agree completely with that, Glenn. I get a phone call probably once a month from different people, various parts of Queensland, saying, I've got this business, I'm thinking about taking it to an IPO. And you really don't want to have that first conversation with me unless you're specifically in an industry or a sector that is really in huge growth and demand. We can't find agricultural businesses that we want to put in front of our investors. You know, the sorts of portfolios I'm managing, and I'm one of 2,700 in Morgans. So, you know, you multiply me, you know, thousands times, and then of course, you know, if we pick up on an idea and we really like it and we think that Green Cross is a good story, I think we've just done research cover on Green Cross. It's taken us years to do that at Morgans. Then, you know, we pick it up as one stockbroking firm, then the next broking firm, you know, you'll see Bell Potter following it, Wilson's, Macquarie, Goldman's, you know, everyone will then sort of follow. So it's really crucial that you do speak to stockbrokers and get inside those corporate advisors' offices and find out really what is actually happening at the coalface. You might have the best business with the most amazing cultural fit and everyone emotionally is right behind you, but if I can't sell that story to my investors, you ain't going to go nowhere fast. Was that positive so that we can end on something? Okay.
And with that, fortunately, there's many stockbrokers out there. So like when we did Green Cross, Morgans almost had it. Then through their wisdoms, they didn't. But as far as like we had to, you know, fortunately, there's a lot of stockbrokers. Everyone has different appetites for different things. So it's a matter of finding the one that wants the opportunity, and yeah, as long as you can find that, you're good to go type of scenario.
And you're right, you really do need to listen to them because we're talking to the other side of the fence all day, every day. What are they buying? You know, if they're not buying it, then there's no point trying to sell it, no matter how good the emotional story that you try to give them. But of course, the first thing that my investor's going to ask me over the phone, do the numbers stack up? Then I can sell the emotional side. I've done the deal. So I need both. And then I'm hoping they've got a damn good accounting and legal firm behind them as well to make sure the whole thing works. So I think we should wrap it up there. I think we've got three very exciting stories to hear from next. And I'll exit the table so that we can have the experts do the questions from here on. So thank you. Sorry, please thank Glenn, Adam and Phil.